We're going to spend about 45 minutes, maybe to an hour, talking about funding. And I know that a number of you guys are finding deals or want to find deals. Some of you guys are wholesalers. You want to fix and flip um, or buy and hold. I do want you to buy and hold. And you've got to get funding. And so we're going to go over some of the different strategies on funding. For those of you guys that don't know me, my name is Gregory Bennett. I've been investing for over 30 years. I've primarily in the DMV area to include Baltimore. I've done lots, I've done lots of creative financing deals, DSCR, and hard money. I've done joint venture agreements and partnerships with people, multi-member LLCs. Haven't done a lot of business credit. So I've got Cami on here and I've got Luis on here, and I think Akia will be on here soon. Some of my platinum coaching investors to talk about their experience in terms of business funding, getting funding using your LLC. And so, if you guys have any questions whatsoever, this period of time is for you to ask your questions. My goal for the webinar is for you guys to leave this webinar really understanding how you're going to fund your next deal. That's my goal for you.
Can you hear me, Greg?
I can hear you now, yes.
Um, if somebody asks me about buying a house, and not me buying a house, but somebody else asks me about buying a house, do you have something that I need to say to them?
If they ask you about buying a house, yeah, we can talk offline about that. We'll
Okay.
talk offline. Just get a hold of me, and then we'll talk offline about that. All right. All right. So look, you guys, 2026, there is an opportunity window. We did see interest rates creep down, which was great for all of us. But then once the war in Iran started, interest rates creep right back up. But as soon as it's over, they're going to come back down, which means there's going to be lots of opportunity for investors. There's more motivated sellers that are entering the market for various reasons, which means that there's opportunity for us. Let me ask you guys a question. If I was to say to you, there's more motivated sellers coming into the market, somebody unmute yourself. Tell me why. Why do you think there's people needing to sell their houses, wanting to sell their houses? Somebody give me an idea of why you think that is. Who knows? Take a guess. Why are there motivated sellers in entering the market? And as investors, we target motivated sellers. And so why are there more motivated sellers entering the market? I just gave you guys a clue.
Because the interest rates are high and they know that a lot of buyers are looking at high interest rates, so they want to go ahead and get the best deal, they don't want their houses there stay on the market too long.
That might be a reason. That might be a reason. Because interest rates are high, to be honest, a lot of motivated sellers are not selling because what in their mind, why are they giving up the interest rate that they have? And a lot of them have like a 2% interest rate, 3%, 4% interest rate. And so a lot of them aren't selling because of that. Now, once interest rates go down, they're going to come off the fence. But there's motivated sellers selling because they've got adjustable rate mortgages that are coming due. And because, kind of to James's point, because interest rates are higher now, they just can't afford these mortgages anymore. In our area, we've got a lot of people who are being laid off because of the federal government. So they've got to sell their properties. And so there's a whole host of reasons why there's a lot of motivated sellers unfortunately selling their properties. We always have unfortunately people who are passing away. So there's probate and estate sales, um, divorce, unfortunately. And so for all those reasons, we've got lots of motivated sellers. We find them every single day. And so we market for them, and I'll talk about marketing soon. but we market for motivated sellers and we talk to them every single day. There's less competition than in peak years. We've got a lot of investors that say, hey, interest rates are high. I'm not coming into the market. I had a conversation with one of my agents yesterday, and he said just that. He doesn't see as many real estate agents selling, and doesn't see as many investors, which means we can take advantage of these opportunities. Um, Funding options, and I'll talk about all the different types of funding options that are out here to include creative financing strategies, and then and partnering, doing JV agreements, and then investors who understand funding win. I was once asked a question by one of my investors that I was coaching. This was a few years ago. What's the one thing that I've got to focus on? She asked me that. What's the one thing that I should be focused on? And I told her the answer is funding, being able to get as much funding as possible because there's opportunities out here. And if you can get funding, lines of credit, and other different types of funding, you win. And the investor that can get the most funding is going to win because now they can take advantage of all the opportunities that we just talked about. All right, the biggest problem investors face is not enough capital. So we never have enough capital. I don't care how many properties that we own. We always want to buy more, and at some point, we just start running out of capital. We start running out of money. So that's a big problem that we face. A confusion about loan options. And my hope for this webinar is to make clear what the options are. Just fear of getting started, analysis paralysis. Um, we can't have that. Like everybody's on here for a reason. And the reason you're on here is because you want to build wealth. And so it has to be more than just looking at this webinar, going to RIA meetings, meetups, looking at videos online. You've got to start taking action. And then another big problem facing investors is just missing real opportunities, not being prepared, not being an opportunist. Luis, you had a question? You had your hand up?
More comment, Greg. I wasn't going to say anything, but I had to. So that funding piece also it's a great backup. So you have a home, and something comes up like a washer dryer issue, maybe the rent. You have that funding to back you up. You have it in your pocket. So I just wanted to add to what you were saying.
So are you referring to reserves from your cash flow or are you referring to like business credit, having that credit card?
Both. Having credit line makes me sleep well at night with my property. When something goes wrong, I can take care of it. It won't dip into my personal funds, capital. So it helps out. So I think having it, I've had plenty of investors tell me, oh man, I ran into this problem. I gotta sell. You've introduced me to some investor who had to sell for one reason or another. So I think funding and extra capital would definitely keep you floating.
And I do think that one reasons why investors fail is because oftentimes they have the financial wherewithal to acquire the property, get it renovated, then refinance, but they're putting all their cash flow in their pocket and they're not saving for a rainy day. Cash flow is not for you to spend. Cash flow is for you to have reserve money just in case, like Luisha said, something goes wrong. And then if you're able to accumulate or save money um, over the months, then put that money somewhere, like into a brokerage account, um, to get a return on your investment so that money can compound. I want you guys to put yourselves in a position where you're building up a portfolio of money, of properties, and then use that cash flow to grow the portfolio, grow your money, putting in that money into a brokerage account. I was talking to a kid the other day, and there's some ETFs that are getting over 20% return. And this is not this is a conversation for another day. Once that brokerage account gets up to a certain level, now you can draw lines of credit against your own brokerage account while that brokerage account is continuing to grow. You've got a line of credit against it to buy even more properties. And then you buy more properties, and then you put the cash flow, save it for a rainy day, and then put the rest back into that brokerage account so that it can continue to compound. And so that's where we need to get to. And that's kind of the point that Luis was making. All right. The truth about funding deals. You don't always need your own money. Deals are structured not to just bought, not just bought. Deals are not just bought. Multiple funding strategies exist, and we're going to go through all of those. And knowledge equals access to deals. What I'll add to that is um, also being in the right communities adds to deals. Being around the right people adds to deals. There's a number of you guys on this webinar tonight that have bought properties, but probably could have bought more if you were just around constantly, consistently around the right people who are doing things. I was thinking to myself today about my own career, and I really got started. Well, one of my first jobs out of college, my degree is in computer science. And so I started off as a computer programmer, then became a systems analyst and senior systems analyst. This is all in my early 20s. And so we were tech guys, but in the office, all we talked about was real estate and real estate investing. And then one guy in the office went and got his real estate license. I said, well, shoot, if he can get his real estate license, I'm gonna get my real estate license too. So then I got my real estate license. But I was around those people. We were talking around about real estate investing, and that was sort of like a springboard for me to really get into real estate and real estate investing. I was around the right people. And so that's what you guys have to purposely do is consistently be around the right people. All right, funding strategies overview. So we're going to talk about these five things. Hard money. We're going to talk about DSCR loans. I don't know if Marvin is on here or not, but he should be on here to talk about that. But if not, I can talk about it. Business funding, creative financing strategies, and JV partnering. All of these good things. I want you guys to take notes. These are all ways that we should be buying properties. All right, let's talk about hard money. And so a hard money loan is short-term financing. Generally speaking, it's a year. Um, with hard money, interest rates now are about 11% and about two and a half, 3 points. Points are percent on the loan amount that's paid up front. The 11%, and different lenders have different terms. You may find a lender where you're not putting down any money. The down payment is generally on a hard money loan, generally speaking, about 10%, 10% of the loan amount. 10% of the loan amount, not the sales price, but 10% of the loan amount. Loan amount often consists of the acquisition, what you're buying the property for, and the rehab costs. For example, if you're buying a property for 100,000, rehab is 50, you're going to get a loan for 150,000. You're going to pay 11% on that 150,000. That's hard money. They call it hard money because it's based on the merits of a hard asset being real estate. Um, Again, it's short term. Most of the ones that we use here want you done in and out in a year, which that's more than enough time. And so the qualifications for you is they're primarily looking at the property. So they base the qualifications on the merits of the property. Those of you who are either in my coaching program or have been through my 4-day course know that they're looking at a formula that consists of 70% of the after repair value minus repair costs. The Mayo formula. Most of you guys already know that. 70%. And so I teach you guys to buy properties at 70% of the after repair value minus repair costs, primarily because that's what the lender is looking for. That's exactly what the lender is looking for. It can be a quick closing. Most of the hard money lenders that I use can close within 2 weeks. The hard money lenders that have their own money can close even shorter than that. They're just waiting for the title work to be done. Hard money is ideal for the BRRRR method. And I'll go over BRRRR on another slide, but BRRRR is buying the property right, renovating it right, renting the property right. And for me, renting the property is renting to a voucher holder and then refinancing out of that hard money into a DSCR loan, which we'll talk about, and then hopefully buying the property right and getting your cash back to then repeat the process. That's BRRRR. So that's basically hard money. There's a number of hard money lenders around, whether you're in Baltimore or Prince George's County or in DC. There's a number of hard money. They are looking for not just credit score from you, which is somewhere around 680, but they're also looking at what they call past performance. And so they want to see that you've done at least one deal. Now, if you haven't done one deal, maybe two deals, depending on the lender, then most of the ones that we use will still approve you, but you just have to put down more money. You're not going to lose any money. You're just putting it down, which means in the end you owe a little less. But you just have to get through the first deal or two. Let's just get through it, and then they start to give you more favorable rates. And then the more past performance you can show, the more higher credit score. Now you're really talking. There's some hard money lenders that you're not going to have to put down any money. But let's get there. Let's do some deals. Let's have some success. And then now we can start talking to some lenders, some hard money lenders, 0% down, no money down. But we've got to slow walk that and get there. Terms, like I said, somewhere between 10 and 12%. And oftentimes, to be honest, it really depends on past performance, also your interest rate. Um, I explained the points, and then keep in mind the between 10 and 12%, that's an annualized return, which means let's just say it's to make the numbers easy. Let's just say it's 10%. If you only keep them for a year, but if you only keep the loan for 6 months, you're not paying 10%. You kept the money half the time, which means you're only paying half of the 10%, which is 5%. So it's annualized over a year. Points are paid up front. So if it's 1 point, you've got to pay 1% of the loan amount up front. Also between 6 and 12%. I'm sorry, 6 and 12 months. And they're funding the purchase price and the rehab. Let me get to that question, Derek. I'm gonna get to that in a minute. And so this is hard money. Akia, I see you on here. Cami, Luis, have I missed anything on the hard money? I got my trusted panel here with me. Some of my
No,
coach
No, I
students
don't
doing.
I
think
wouldn't.
so.
Did I
I
miss
wouldn't.
anything?
Yeah, everything.
Yeah. Yeah, I agree. This is covers everything.
Looks good to me.
All right, Charity's asking the question. I think she's asking basically what's past performance? What is considered a past deal for approval? Um, I'm thinking most lenders want to see a deal that you've done in the last 12 months, be it a be it a buy and hold or a flip, where they see that your name or your LLC's name's on a settlement statement for purchase, and if you're flipping, a settlement statement that you sold the property. You can prove past performance there. Um, IKEA or Cami, any is that right? You guys want to add to that in terms of past performance?
No, I think that's it. I
I know the
guess,
last,
go ahead, Kimmy.
no, I was gonna say, I know the last lender I talked to, they said 24 months.
Hmm. That's even better. That's even better. Go ahead, Bill.
Hey, just a quick question on the past deals into generate your portfolio. Can does that also count if you JV with someone?
Absolutely.
Okay, thank you.
Absolutely. As long as you can get your name on the settlement statement, your LLC, get it on there. Sometimes I've put some of my coaching students LLCs on a settlement statement, and it just says they put up $5,000 for the deal. And so that was past performance for them. Then after the deal, I just gave them back the 5,000. But that was showing past performance. So you just want your name or your LLC's name on a settlement statement, and that shows past performance. And so you guys, I want you guys in this for the long haul, which means sometimes you've got to bite the bullet and put down more money if you have it, or get a private lender or JV partner to help you with the money, so that if you can get through one or two deals, now everything gets a lot easier. And we literally are buying properties using no money. All right, DSCR loans. Hey, Keith, is Marvin on here? Marvin, are you here? Okay, that's okay. All right, so DSCR loans. And so we go from a hard money loan, which is short-term financing, up to a year. Now, at some point, we've got to refinance out of that, because if we go past a year, they're going to start charging us enormous late fees. And so we've got to refinance out. We generally refinance into what's called a DSCR loan. A DSCR loan is primarily a loan that's really based on the cash flow of the property or the performance of one's property. The lenders they want to make sure that your mortgage payment, when they refinance you, that your mortgage payment is going to be equal to or less than the cash flow that's coming in. I personally call it a cash flow loan. They want to make sure that you've got the cash flow, that the cash flow is coming in, because they want to guarantee to themselves that if they give you this loan, that you've got money to pay. And so you don't always necessarily have to have the property already rented out. If not, then they'll look at the market rent. And so they'll run their own comps and say, okay, in this area, rents are, let's just say 3,500. When we refinance, we're refinancing 300,000. The payment is only going to be 2,500. There's going to be $1,000 cash flow. We're going to approve this loan. On a DSCR loan, they are going to look at your credit score. But as an investor, these are the type of loans that we want. You've got to have owned your property for at least 6 months. So you've got to season it for 6 months. You have to hold it for 6 months. Let's see, it's based on the rental income. They're not looking at anything personal to you. So no personal income. They will look at your credit score. This is long-term financing, and it's just ideal for rentals. Ideal for rentals. Um, you guys want to add to this, the DSCR? Um, Cami or Akia?
Greg,
Um,
can you repeat what you said about the 6 months, please?
You have to have owned the property. For most of the lenders, you have to have owned the property for 6 months. Now you're gonna go through the hard money process of renovating the property. Um, you're going to buy the property. You're going to go through a renovation process. You're going to go through a process where you're looking for a tenant. All that's going to take over 6 months. And so they just primarily want you to have owned the property for at least 6 months. They call it seasoning. So you just have to own the property for 6 months.
Greg, is that to say that that's why the hard money lender come in before the DSC loan?
Yeah, you can do it. You don't have to do it that way. You can pay cash. You can get a private lender. You can use a line of credit, but most of us use a hard money loan, a hard money lender. All right, here's an
I guess
example.
I would, Greg, I would also add, to your other slide is, uh, for DSCR, some lenders allow up to, 10 years of interest only payments. And then I would also add, um, often times there's a pre-penalty, um,
Prepayment.
prepayment penalty if you try to get out of your DSCR loan, within a certain amount of time. Um, yeah, I would add that.
So interest only for 10 years. How do you feel about that? I mean, it would make the payment lower, but at the same time, you're not paying down on the principal. But if you're in an area that you're getting good appreciation, it might not matter. But I know the cash flow is there. How do you feel about that, Akia? Interest only payments.
I know you and I was talking about that the other day. Like, if, like you said, if the cash flow is there, you're especially if like you're in DC, um, where there's high appreciation, then it may just be in your interest to take interest only, just to maximize your cash flow. And even though you don't have to pay down to your principal, you can always add money to your principal. Um,
You can
yeah,
pay extra for your
you can
principal.
pay
Yeah.
extra. Yep, yep.
Go ahead, Luther.
I actually bought a property where it was interest only payment, but it was only 3 years. And the cash flow covered it and then was able to refinance out into a better loan. Um, it wasn't ideal, but sometimes it may be necessary because of how money is flowing to go into your next deal. But that 3 years was a whole lot better than the 10.
And you took that. You took the 3 years and just made interest only payments, right?
Yeah, the tenant that was in it was giving me cash flow. I did the 3 years, and then after the 3 years, refinanced it into a much better loan.
Okay.
So Luther, are you saying, or you take the position that because it was a 3-year interest only, I'm assuming it was also a 3-year prepayment penalty where like you could, refinance out and not get hit with the penalty.
Right. I got locked in. It was 3 years interest only, and it was a prepayment penalty. So I just bit the bullet and rolled in for the 3 years because I had decent tenant, decent cash flow. And as soon as I got to that, I was because I had a little bit of equity in it, I refinanced out of it into a better loan. Got even better cash flow because the rent had gone up. But at the time, that's what I could get based on I had multiple deals going and I needed to hurry up and get out of the hard money loan.
Got it.
Okay. That's good. Any other questions or comments about DSCR?
I have a comment question. Well, more so a question. The refinance process I'm going through right now, Greg, the lender told me that yes, it's a DSCR, but it will be in my own name. And then
Oh,
I Googled that.
they're not gonna let you put in an LLC?
Yeah, no, he said you can't, and he said because even if it's an LLC anyways, I would be a personal guarantor,
That's okay.
so it doesn't matter.
Yeah. I mean, what you might want to do is just close on it in your name
Yeah.
and just go back and put in an LLC.
I could do that without doing like a transfer tax, not getting hit with the transfer tax?
Yeah, you're gonna get hit with that. I mean, we
Okay.
we can talk offline about that. I might be able
Okay.
to get a title company to give you a break on that.
Okay. Okay. Thanks.
All right, so with the DSCR example is $1,800 a month rent. Loan is based on cash flow. I'll give you guys a better example in a minute. Long-term hold, you're building passive income. So a great way to build passive income, you guys, and to build your portfolio is to buy a property right using our formula, 70% of the after repair value minus repair costs, using hard money to purchase the property and then refinancing out. My preference would be for you guys to refinance out um, and get money back, doing a cash out refinance. Creative financing strategies. Before we get here, I want to I want to bring in Cammy. You want to talk a little bit about some of the financing that you've done on some deals, on some recent deals that you've done and how you financed them?
I've only done personal financing and hard money loan. And then as far as fund and grow, I've done business credit for mostly materials.
Okay. Talk about business credit. How'd you get
Typically,
it? How did Fund and Grow work? Because there are some people on here that are interested in using business credit to finance some parts of their deals.
so Fund and Grow is a company that basically will help you get business credit without documentation of revenue coming into the company. So they call it no doc. It's a fixed fee versus a percentage of the amount that you get. So let's say they charge you $4,000 versus 10% of what you get. So if they give you 50,000, then you'd pay 5,000. So it's actually a really good deal. Um, they handle the majority of the negotiations and also the application so that you don't have to answer questions that you might maybe mess up the deal. They know how to answer it. So typically what I've seen, and Luis and Akia, you can correct me if I'm wrong, what I've seen is if it's a female that's applying, then they typically have a female like client executive working with you because then I guess they act as if they're you when they negotiate those costs. Because the things that they can negotiate after they actually get you the funding is say you already have an American Express account, and say you have 30,000 on that account, but then they give you 40,000, then they can move maybe 20,000 of that onto this new card, and then that card would be 0% for let's say 12 to 18 months. So they do those kinds. Not that you can't do those kinds of negotiations, you can always do it after the fact, but they kind of do it on the fly with you, and then they kind of consider that. It's called Fund and Grow, ampersand Grow, FUND and GROW. And then one of the other things I like about them is that you can get the money within weeks. Like they kind of schedule you for the application round, and then within like sometimes even a week, you can have the funding. And since it goes on your business credit, it doesn't affect your debt to income ratio, so it doesn't bring your credit down. I mean, your credit will take a hit on the inquiries, but then after that, that line of credit doesn't go on your personal credit, so it doesn't show when you're using it. It doesn't show that you have like extra credit on your personal credit.
And then they give you the money on a credit card, right?
Right.
And what are the best uses of the credit card? So they're going to give you a certain amount of money. Um, and then what are the best uses for that to use that credit card when we're either buying properties or renovating properties? What's the best use for it?
So you could use it for like short-term capital gaps. So say for instance, if you found a title company that would allow you to charge the difference between what you actually have for closing, so you could use it for short-term gaps. You can even use it for acquisition. They have a thing out there called Plastique or Milio that you can actually take cash off the cards, like a cash advance, if you needed to like the auctions that we go to, it starts at like $5,000, and you need to bring $3,000 cashier's check up front. So you could use it to take cash off the card and get a cashier's check for that. For smaller rehabs, it would be great. So say if you had like a $30,000 rehab, or even a $50,000 rehab, you could use two credit cards or one credit card for that. And then let me think. I mean, you could use it not even for like property. Say if you wanted to do get a VA or something like that, if you want to do wholesaling. So I mean, you can use it really for anything. And obviously you can use it for materials if you needed to, buy materials.
Buy materials, that's big. I like what Akia put in the chat. You can also use it for PayPal and Cash App to like pay contractors. And
That
so I
is very
think
true.
that's big. Um, Luis, you want to add anything to Fund and Grow or business credit? Like how
Nah,
do you
man.
how do you
Akia and Cammy took everything. They took all the information from me. I had all these talking points. No,
uh,
jokes aside, I would add that you do it by rounds, right, Cammy? So you get rounds and you get quarters. And so the first quarter, what they'll do is they'll do up different banks, and then they'll come back within several months and do another quarter, and then they'll sometimes add a bank or they'll continue with the same banks. And what caught my ear, and I like what Akia put in the chat box. That's really genius, by the way. But what my person said, and she's a female. So what she said, Michelle said, was she was like, well, you gotta use because you want to show the credit card companies you're using it. And I was like, I don't know how else to use it. I bought everything I need. And she said, well, no. What you could do is just pay your rent and use that case scenario. I was like, oh, I didn't think about that. So I think that's pretty neat. That if what I have Section 8 right now, but if my tenant were if they were not on Section 8, I could use that credit line in case if my tenant came down on hard times and I really needed to take care of business. I could use it for that piece as well. That's the only thing I would add.
and initially, Luis, what's the interest rate on the card initially?
So you don't on the cards that I have, there's no interest rate. You have a credit line and you have a certain amount to pay within a certain amount of time. And there is no percentages in the beginning from the ones that I have. I don't have any percentages. It's interest free. And some of them are like 6 months, 9 months, 1 year. It
Yeah,
all
so it's
depends.
that's the question. So it's interest-free money up until what point?
It depends on the credit card. So I have some that are 6 months, I have some that are 9 months, and I have some that are 1 year. Just depends on which one you get.
Right.
And
Okay.
can I add, with Fund and Grow, um, and I think that this will apply to just any business credit card or any business credit line. So although I was approved for 250,000, I just only took the first round, and I'm coming up on 1 year. So I only took the first round. And out of that first round, I think I got 53,000, but I've only used like 35,000. And the reason why is I'm more of a, it's also knowing like your risk tolerance. Like I'm what I would consider myself kind of a more conservative investor. And I knew this money was eventually going to come due. So I just used kind of what I needed just to, to do my last project. So that's also something to think about. Just because you're given money, right, for deals doesn't mean you have to use all of it. So
And then what are the qualifications? I think I know one is, well, what are the qualifications? You've got to have an LLC, right? Go ahead, Luis.
yeah, I was gonna say,
So they go ahead, Kim. Go
I was gonna say Cammy or Luis.
ahead. So they definitely look at your credit score, your personal and business. LLC helps. I can't remember if they required me to have one. I already have one. I mean, this is the nature of the business. So if you're in here to do things like what I'm doing, Cammy doing, Akia doing, you definitely want a business name, an established business name. And then if I remember correctly, my business should have been established for at least 2 years, if I remember correctly. Am I right on that, Akia?
Yeah. And
Yeah.
Cammy, please correct me if that's wrong. Okay.
Yeah, another company that I used was 2 years, but I think Fund and Grow was like 6 months. I think they were a lot less because it just over
Mm,
the years. Yeah, I think they changed it.
okay. And then also, Greg, they have deals. So I tried to get a deal. Unfortunately, I wasn't able to get it. But
Yeah,
they do
yeah.
have deals throughout the year.
Well,
And so,
explain that. I think that's important.
sure. So, I mean, I think the flatline cost, and don't quote me, but feel free to use any one of our three names whenever you go there for referral. But if I remember correctly, it was like roughly 3,500. And then on certain holidays, they'll decrease it to 3,000. And that's a one, like Cami said earlier. And then I remember around Christmas time or July 4th, they had a deal where it's 2 for 1. So let's say, Greg, for instance, you wanted credit line and I wanted credit line. You and I can go in there, split the $3,500, and then we would be completely handled separately. So you wouldn't know my business and I wouldn't know yours. And I think that's a great deal. So you pay half of 3,500 and you get all the benefits that you would if you would have paid 3,500. That's what I mean by deals.
So you want to go in as with partners. And so if anybody's interested, just let me know. I can probably hook you up with someone else. Like I tried to hook up Luis with someone else, a couple people actually, and didn't work out for him. So he had to put up the money up front. But they do have a partnership program where let's just say it's whatever, 3,500, you can split that money with someone else who's going in. You go in together, split the money, but they approve you and all the information is separate.
Greg, if I can add to that, one of the folks that I won't discuss details, but someone they what they do is they run your credit and your business credit. And if you're too heavy in any of those, you won't qualify. So make sure when you do get a partner, that partner is clear and they don't have too much debt, because that will affect whether they can go through or not.
And if they don't go through, we try to choose someone else. So overall, Akia, what's the importance of business credit? How has that helped you in your deals?
I would say it's helped me like manage projects and to some extent like scale. I think it plays a role in just me being able to scale. Yeah, I would say management for projects and scaling.
In terms of cash, having cash
Yeah.
for change orders,
Hmm.
materials, things like that.
Yeah.
How about you? How about you, Cammy?
Yeah, same. So for one of my gut rehabs, the framing was, I want to say like 30 something thousand in materials because it was a over 3,000 square foot place. So um I would have to put that on a personal credit card, and then that would affect my, debt to income ratio and bring my credit rating down. So it really helps for definitely the larger purchases. And then like Akia was saying, paying the contractors and stuff because they want to be paid as soon as they're done. So
And what about you, Luis? How has this helped you, if at all?
It's given me it's allowed me to use my money in different areas. So right now I'm looking for my next investment, and I don't have to stress about all that needs to be fixed. I don't have to stress about that. I might need a washer and dryer. I don't have to stress about that. That gives me a lot of reassurance to be able to set up for my next deal. And I think that's the main thing that you're trying to deliver, Greg, tonight and your other nights, is that you're always planning for the next deal, and so that's what it's.
Yeah, I think you need to use your Fund and Grow credit card to get a better phone, Luis.
I
Um,
apologize. I apologize.
can I add one more thing, Greg?
yeah, if but say something about Luis's phone.
I will not say anything about my brother. I apologize. I can't do that. What I will say, what Akia said, was really key, that even though she got a larger approval amount, she, took what she could handle because it doesn't make sense to get credit that you can't pay back because 0%, if it's 6 months, that 6 months is going to come fast, or that year is going to come fast. So not overspending, being a good steward, I guess is what I'm trying to say, is really important with these because if you mess it up, it does affect your business credit, but then ultimately you're personally responsible for it. So it can also affect your personal credit.
So you guys are in the coaching program. You guys are in the same accountability group. How did you guys learn about Fund and Grow?
Cammy.
Cammy, Cammy, you initiated all this and shared the information,
Yeah, I had used it right before I came into the program.
and you shared. Look at
Well,
this.
it was like I said, it was a better deal than the previous one I used because the previous one was a fixed amount, but this one it was a twofer. So actually my son and I did it prior to me coming into the program. So I think it was 3,800. So we only paid 1,900 each.
Okay. Okay. All right. Any questions, you guys? Any more questions about business funding? Um, a- a- any questions there, you guys? You guys did a great job, by the way.
I have a question.
I have,
Go ahead.
Hi, this is Iris. I have a question about the business funding. How you doing, Greg? Um,
Good.
the last person spoke about I can't, I wasn't sure if I put something in the chat. Was it that the business funding you can do with so say for instance, you want to use a hard money lender, and he was saying that the hard money lender, you can put zero down or 5% or 10% down. Can you list those hard money lenders, Greg? Because
I'll
mine's
let,
always wanted 20% down.
yeah, just contact me, Iris.
Okay.
I'll do that offline.
Okay. I'll do that.
Okay. Any
Okay.
other?
Thank you.
Okay. Any other questions, you guys?
hi. I just had a quick question. This is Latoya. I'm currently working with MB Capital Solutions and just wanted to know if anyone heard of them for business credit.
Yeah, that was the first one that I used. They were charging 5,000 as a fixed fee no matter what you got. And that's why I said, I mean, they were good. They did the same thing. It's just that I paid less and I got more rounds. So for MB Capital, I only got one round for that $5,000, and I got up to 4 rounds with Fund and Grow. I only used 3 of them, but I got, like Luis was saying, I got to do a round quarterly.
Okay, great. That's good information. Thank you.
Oh, Judy said she's using them now. Oh, Jerry Judy said he's using them now. Okay, good. All right, so let's just move on. If you guys have any other questions, just as far as that's concerned, let me know. Let me talk quickly about creative financing strategies, subject to seller financing, lease options, and partnering. Let me talk about that. Um, Derek, I think the link, look up. I think the link is in the chat for Fund and Grow. All right, subject two. Subject two is when we're taking over one's mortgage. We're not assuming their mortgage, we're taking over the existing mortgage. So the existing mortgage is staying on the property. And we're primarily looking for properties that have low interest rates, lower than what we can get now. And so it's much better and a lot less money down. Nobody's looking at your credit to try to take over one's mortgage. And subject to has been popularized by uh, Pace Morby. And so there's a lot of investors across the country doing that. And so whenever you're going to do some marketing, and we teach that in our courses, and whenever you come across a seller that has a mortgage, the first thing I want you guys to think about is, well, maybe I can take over that mortgage. You want to ask them what the interest rate is, what the monthly payment is, what the mortgage balance is. I had a property in I think that was in Charles County, and one of my investors was calling a list of pre-foreclosures. Came across this lady. Her house was going to foreclosure in like 3 or 4 weeks, something like that, and she's just going to let it foreclose. But she allowed me to come to the property. When I looked at the mortgage payment and then looked at what the arrears was, I put the arrears on top of the mortgage balance, and then I looked at the after repair value, and all the numbers worked for me. So I said to her, would you be open to me just bringing your mortgage current and taking over the mortgage payments? And for that, I'll give you $10,000 when we go to settlement. And she said yes. I've done numerous subject twos. I think subject two is something that you guys should be thinking about doing, especially for buy and hold. Um, until interest rates can come down, one of your first and best option is trying to do a subject to. So that's subject to. You're going to keep that existing mortgage on the property. You're actually going to go to settlement. My preference would be for you to settle on the property and putting the property in a trust. Because if the lender finds out that you took over the existing mortgage, they could call the loan, meaning the loan is due today, the mortgage balance. But if they see that it's in a trust, then they're going to think, oh, they must be doing estate planning. So I would put the property in a trust when you take over the mortgage. So that's subject to. Um, let me see something. Let me just explain the other strategies. I don't know if I got a slide for the other ones. Seller financing is if a seller owns the property free and clear. One of the questions you want to ask when you meet a seller is how much what's the mortgage balance? If they say there's no mortgage balance, the first thing I want you to think about is not subject to, because it's not a mortgage to take over. It's a seller financing. You want the seller to be the bank. And you want to ask the seller, would you be open to financing this deal for me for a short period of time? Generally, sellers who own properties free and clear, they don't want the big hit capital gain today. They rather take the capital gain hit, say 5 years from now when they're in a lower tax bracket, may agree to do that. And so we've done a number of seller financing. We get to pick our rates. It's a negotiation, but obviously we're going to pick a rate lower than what the interest rates are now. And they're the bank. The very, very first property I ever bought was seller financing. They financed it was a condo in DuPont Circle where I asked them, I just read a chapter in Carlton Sheets manual, and I went down there. I was 23 years old, and I said, "Would you finance this for me?" Doing seller financing, and they agreed. And we went to settlement a few weeks later, and I owned my first property. It was a two-bedroom at 17th and P in the heart of DuPont Circle, and I rented that out for 5 years. 5 years later, I refinanced and paid them off. And so that's an example of seller financing. Lease options. Um, a great way to control a property for 2 or 3 years is to do a lease option with the option to buy and an option to sublease the property. You want to lock into the sales price today, hold it for the 2 or 3 years, let it appreciate in value. Now you've got even more equity. Lease it to someone else to get cash flow for yourself without actually having to close on it. Um, and then so that's a win-win. So lease options. Um, I think that's all the creative financing subject to lease op. And then partnerships. Let's talk a little bit about partnerships. I think in this day and age, and we've done this in our coaching program, where you can leverage someone else's skill set, someone else's capital, someone else's credit to buy more properties. I think a couple of you guys now in our coaching program, one told me today that they're looking at partnering with someone else that's in our coaching program, and you guys are talking about flipping properties. You guys already have a deal in hand. I just think that's wonderful because some of these deals, or some of you don't always have the capital. And um, and so pooling each other's capital together to start buying deals. And then I heard the plan was to flip that property and then use that money to then go and buy and hold, which I think is a great idea. So doing joint ventures, we had two of our coaching students do joint ventures last year. I just heard of one today where you guys are going to do a JV, and that counts as past performance once you guys do it. And so again, being part of a community, like-minded people with the same goals and the same mindset, just helps you scale your business fast. And so that's the importance of being part of a community and doing joint ventures together. Funding comparison, hard money, fast. Um, Expensive, short-term DSCR, stable, rental-based, long-term creative financing, flexible, low money, and negotiation-based. All right, combining strategies. And so my model with flipping properties, my model, and Latoya, I want you to hear this. My model is to use hard money to purchase the properties and for acquisition. So to purchase the property, I'm sorry, for to purchase the property, so acquisition and rehab hard money. Also, I use a private lender to put up the money for closing costs and to get started with the first draw. So a typical deal, I did a deal in Woodridge in Northeast DC where I bought the property for 300,000. Renovation was, let's just say 80,000. So 380. I used a hard money lender for the 380, hard money lender. I needed to bring about $50,000, no, $30,000 to the table, and I needed another $20,000 to get the contractor started. So I needed another 50,000. I borrowed that from a private lender, closed the deal, had the 20 to get the contractor started with the first draw. They got through the first draw, and then the lender sent me the money for the first draw. I We renovated the property, put it on the market, sold it, paid off the hard money lender, paid off the private lender. On that deal, made about $60,000 using none of my own money. I combined hard money with a private lender to purchase that property. And so that's how you buy real estate using none of your own money. And I could have done that with a flip. I mean, with a buy and hold as well, especially if I bought the property right and did a cash out refinance and paid everybody back. But we do combine the different strategies to buy properties, whether we're flipping the properties or buying and holding the properties. Especially if we're doing Burr, then that's really, really easy. And so I want you to understand all the different strategies so that you can use the different strategies together, including joint venture deals to buy and hold properties and flip properties. All right, so this is a real deal. I did this last week. So I want you guys to understand kind of what I just said. I want you guys to take out your calculators really, really quickly. Take out your calculators. So this property, it's in the zip code 21229. The purchase price was 110,000. Renovation cost was 60,000. Rents is 2,300. After repair value is 250. You guys with me? Um, all right, so put in your calculator. We already know the math. I just want you to put in the calculator. Acquisition or purchase price is 110. So 110,000 plus 60,000. And we get 170,000. So the 170,000 is what we're financing. We're financing 170,000. We're going to the hard money lender and say, we'd like to purchase this property. We need to borrow 170,000. ARV after repair value is 250,000. Now they're going to do the math to make sure that this is a good deal. And so let's say that they've done the math, it's a good deal. They've lent you the money. You renovated the property, or you purchased the property, you renovated the property, and let's say you rented the property out for 2,300. You rented it out for 2,300. Now it's time to refinance out of the hard money loan. And so let's say we were able to find comps to get it appraised for 250. So put in your calculator 250,000. So we put 250,000 and let's multiply that by, we're going to refinance out using 80%. 80%. One number I left out, we're financing 170,000. And let's say that the hard money lender said that we've got to put down 10%, which is 17,000. So we've got to put up a total of 17,000. If we take the 250,000, multiply that by 80%, so we're going to get an 80% loan to value from the hard money lender. I mean, from the DSCR lender. DSC, they're not going to give us the full amount of 250. They're going to give us 80%. So 80% of 250,000 is 200,000. They're going to give us that money. We're refinancing. The cash flow is more than the mortgage payment. They're going to give us the 200,000. With that 200,000, we're going to pay off the 170 that we borrowed from the hard money lender, which leaves $30,000, right? We put up 17, we got 30,000 back. That's a cash out refinance. So now we use that money to repeat the process. Any questions there? I know I went a little fast. This is being recorded. But on the DSCR loan, we're looking to get either 75% or 80% of the after repair value. In this case, after repair value is 250. 80% of the 250 is 200. So we're getting 200 from the DSCR lender, but we only borrowed 170 from the hard money lender. So we're going to pay them back with the 200. Now we got 30,000 left. We only put up 17,000 for the deal. So now we got more back than we even put up. And so what I just described is a real deal and it's the Burr method. So we bought the property right. We renovated it right. We rented it right. And now we refinanced, did a cash out with DSCR. And then now with the cash that we got back, we're repeating the process. That's the Burr method. This is actually a real deal in Baltimore. And this is where we need to be. And so whether you're flipping, I mean, well, this is primarily to hold. So this is to hold a property. Now, with that cash, that capital, we're going to reinvest that capital into another property and do the same thing. So we're going to build our portfolio with the same capital. Any questions here, you guys? You guys have to understand this in order to keep going, buying more properties. Any questions here? All right. All right. How to get approved faster. have your deal ready. Meet with the lender. Meet with the lender for acquisition. Also meet with the lender for the refinance upfront. Know your numbers. Um, Build a relationship with the lender. Some of you guys have relationships with lenders, they know you. Some even have relationships with appraisers. And then move quickly on the deals. Biggest mistakes that I see, not understanding terms, being over leveraged, no exit strategy, and poor deal analysis. I talked to someone today who bought a property at a tax auction in DC, and they called me and said, well, I bought this property. I really didn't do the due diligence, and now I'm stuck with the property. I don't know what to do with it. And I said, look, man, next time you buy a property, let me like run it by me. Don't don't have too much pride. Run that thing by me. I could have saved you $30,000. Bought a lot and come to find out, didn't do his due diligence. Come to find out it's not a buildable lot. Now he's stuck with the property, asking me what he should do with the property. I said, the only thing you can do is try to sell it to the neighbor to extend their lot, but don't do a property unless I know about it. I want to help you guys, and so if you guys have a property, I'm open to just taking a look at it to see if it's a good deal or not. All right, so we work with investors. You guys just talked to Akia, Cami, and Luis. We'd love to help you structure your deals, help you get the funding that we've talked about. We've got relationships with DSCR lenders, with hard money lenders, private lenders. They talked about Fund and Grow. We can help you guys out. We do have a platinum coaching program. If you're interested in our coaching program, just go to gbschedule.com. That's my scheduler. I'd love to talk to you guys about scaling your business, growing your wealth. You cannot do it on your own. You cannot do it by yourself. So go to GB Schedule, go there now, and let's talk about our coaching program, see if it's a good fit. Those of you guys who have not been to my 4-day course, it's only a $27 investment, just $27. We get 4 days of training, and I've added a bonus fifth day tour. So we'll have 4 days of virtual training where we'll go over how to find deals, how to fund deals, how to analyze deals, best neighborhoods to invest in. That's all virtual from 8 to 9, Monday through Thursday. And then on Saturday, we actually go out in the field and look at a property, all for a $27 investment. Best deal in town. None of you guys have been through my 4-day. If you haven't been or want to go through it again, just go to BBC 4-day. It does fill up fast. There's only so many people we can take out in the field that Saturday, but just $27. And that includes lunch on that Saturday. All right, any questions, you guys? We went through a lot. We went through it really fast. This is being recorded, so you guys will get the recording. Any questions? Any concerns? Any takeaways? What did you guys take away from tonight? Did you learn anything that you didn't already know?
Greg, I would like to say I learned a lot as usual, and I want to just know, do you have a class on this Saturday as well?
No, we don't have anything Saturday.
Okay, thank you.
Anybody else? All right. So I want to thank Luis. Cammy stayed on. Very good, Cammy. Cammy, you didn't fall asleep on us. It's 9:13. I'm proud of you. Um,
I did
Leave
fall
her
asleep.
alone, Greg. Leave her alone.
That's
okay.
my bro.
I'm sorry. I'm sorry, Cammy.
I got you, Cammy.
Cammy, you called me old today, by the way. You did. Akia, thank you so much, Akia. Thank you guys. And so look, we're here to help you. We all learn, Hattie's part of us. We all learn from each other. Cami actually brought Fund and Grow to the group last year. And so, and the number of people in our coaching program used Fund and Grow. I think Popcorn used Fund and Grow also. And so, and we've gone out to each other's deals, wherever they are, DC, Baltimore, whatever. That's what you guys need. And so if you guys are interested, again, hit me up on my scheduler, GB schedule. If there's a time that you guys want and you don't see, DM me, call me, just let me know. I can move around my schedule. Let me put my phone number in here because I think next week it looks like it's booked up 4513, but it's really not. So here's my phone number. You guys can call me, text me. If you see if there's a time that you want to meet and it's not available, just send me a text message. And then again, the 4-day course, it's dynamite. A number of you guys have been through my 4-day course. But if you haven't, go to bb4day.com. All right, you guys. That's all I have. Thank you guys. Good luck in your journey. We want to see everybody win. I want to see everybody build wealth for yourselves. I take a lot of calls, you guys, with people failing. And I actually went to a property Saturday where someone just didn't ask for help. And it's not a disaster, but could be better. And so get help, you guys. Get lots of help. Go ahead, Luis.
Hey, Greg, to touch on that, you might come meet me tomorrow on my property, my future property, through a lot of traffic, right?
I, I I'm dedicated to your success, even though I have to go through a lot of traffic and sweat, and I'll be there in Capitol Heights tomorrow at 3:30, my brother.
You have a nice car. I'll text you the address. Thanks again, Greg. Appreciate it. Great program, by the way.
Good. Darrington, did you have a question? I think I saw Darrington's hand up. Did I see Darrington's hand up? Maybe not. All right, you guys. That's all I have. Hopefully, we see you guys down the road. Good luck with your journey, you guys. And if there's anything that we can do to help you build wealth, please let us know. All right, you guys. Take care. God bless. And we will talk to you guys soon. Good night, everybody.
Thanks a lot. Good night.
Good night. Thank you,
Thank
Greg.
you.
Thank you
Thank you.
kindly.
Good
And
night.
Thank you,
a
Greg. Talk
pleasure
to you
as
later.
usual.
All right, good night.
Good night.